I had a nice discussion on Friday about the fact that investors are either worried about the yield curve flattening or they're worried about rising long end rates hurting growth. And you can't have both at the same time. Which are you more worried about?
Well, you can have both times. It's just different risks, right? It's going to have different effects. So, no, trust me, investors can worry about both. We don't worry about it flattening at the moment because obviously it's not inverted yet, and so flattening would mean the Fed raising short rates faster than the long rates rising and the expansion continuing. I also don't think that a modest steepening the way we saw is particularly bad news. If it doesn't happen too fast, it's that pace of increase in long rates that is really the major issue certainly for equity markets. And I think we debate now whether you're going to see a major change in long-run productivity and inflation expectations and the 30-year yield rise significantly. We probably say not, or if you're going to see a continuation to the overall flattening trend in the yield curve that we've seen. We think the yield curve is going to be flat next summer as the market wakes up to a slowdown in US growth.
And that has got a consequence, of course, for our rather Boolean view of earnings. We've put into the GTV library, I've put in US, and then I've stripped out the US. So you've got MSCI USA, and then I have MSCI excluding the United States. My question to you is this, David. Obviously, the natural position for most of our guests is, oh, we want to be overweight the US, be long the US, continue to be long the US. When you hear Donald Trump talking about a new middle-class tax cut, David, does that, as it were, bolster that case?
Yes, absolutely. Tax cuts obviously are something that boost the domestic demand and the earnings of the companies linked to it. I think that if the tax cut was to come about, and again, this is just something that was said recently with no apparently knowledge of it from his party, then you would see another boost to earnings and more positive sentiment for the US. At least this is going to continue until the debt issues really become a binding constraint for America, and we are many years from that, unfortunately. So these tax cuts may be fantastic for investors and good for the stock market, and arguably could reinforce a bias to the United States. But of course, they are increasingly damaging the balance sheet of the United States to the detriment of its ability to service its citizens.
As we talk about tax cuts, let's bring up the midterms, and you've done research around this at JPMorgan. How much could midterm season this time around, and that's the crucial phrase I want to highlight, actually give a boost to a risk-on rally to year-end?
Well, in almost every midterm season, we see a pattern where there's choppy action going into it as there's uncertainty, and then because the uncertainty is lifted, regardless of who won or lost and who else is in the White House, you tend to see a modest rally in equities. We don't believe this is something that most of our clients should be trying to trade around. We have some very active clients who do trade, and there's potentially some ideas there. But the vast majority of our clients, this is not the kind of thing we want to reset our asset allocation around. Obviously, one of the more extreme events that are not expected right now, that the Republicans holding both houses, for example, or the Democrats taking both houses, neither of which is expected, would probably lead to a market, a bit of turbulence, probably very positive for the Republican side. But the expected outcome, Democrats take the House, Republicans hold the Senate. We imagine that there'll be a modest relief rally, but not a huge amount to trade around.